Good day and Pauline peace. My name is Shyne B Manlapas, and in this video, our group will be discussing about our investment proposal as part of our requirement for financial management, a capstone project. So before we proceed in the details of our project, let us know first what is investing.
Here, Wall Street Willie, what is investing? Investing is an action you take with your money to make it grow. There are many things you could invest your money in. Some popular options for investing are stocks, bonds, and real estate, all of which help your money grow. When you put your money in these avenues, they become your investments. Can you give me an example of how my money could grow when I invest it? On average, the stock market provides a return of around 11% per year over the long term. If you invested $5,000 in the stock market today, then in 20 years, you would have around $40,000, and in 30 years, you'd have well over $100,000, all from just the original $5,000 investment. That's the power of investing. You could turn $5,000 into well over $100,000. How much money do I need to start investing? There is a common misconception that you need a lot of money to start investing, but that couldn't be farther from the truth. Even if you set aside just $1 every day for investment, that money could grow into over $70,000 in 30 years. Who should invest? Is it only for adults who have a steady income? Absolutely not. Everyone can and should invest whatever amount they can. When should I start investing? The best time to start investing is now. The earlier you start investing, the more time your money has to grow.
So now I will present to you the given problem for our project. So there is a 100 million excess liquidity that cannot be reinvested into the operations, and 80 million existing debt with 1% interest per annum for a term of 5 years. Inflation is expected to range from 4% to 8% for 5 years. So we are looking for the best investment on the following options. First, we have the S&P index. Second, PSE index. Third, gold. Fourth, Bitcoin. Fifth, Philippine Treasury bond. Sixth, pay off the debt. And seventh, US dollar. So in this project, investment is all in. One investment choice only with investment horizon of 5 years. Consider taxes and foreign exchange conversion, and we will use historical data of 10 years as basis for calculations. So now we will proceed to the discussion and calculation for each investment options. So for my part, I will discuss the first two options, which is S&P index and PSE index. So we have here first the S&P 500 index. The Standard & Poor's 500 index, also known as the S&P 500, is the largest corporations in the United States and the registered brand of the S&P Dow Jones Indices joint venture, commonly considered to be the most precise gauge of stock market performance in the United States. It is America's most important 500 companies' achievements. The index is not an exact list of top 500 US corporations by market capitalization because it has additional standards for inclusion. The index is often regarded as the most reliable measure of large-cap US equities. It employs free-floating shares traded by the general public. To account for fresh share issuance or corporate mergers, it updates each firm's market valuation. The index value is determined by adding together each company's adjusted market capitalization and dividing the result by a divisor. Unfortunately, the divisor is S&P private information and is not available to general public. The S&P 500 is a float-weighted index that focuses on a large-cap sector of the U.S. stock market, and the firm market capitalizations are adjusted. So here we have the S&P 500 Index historical annual data. So it is for year 2011 to 2021. So for year 2011, we have the average closing price of 1,267.64, year open 1,271.87, year high 1,363.61, year low 1,099.23, year close 1,257.60, and for annual percent change, we have 0%. And for year 2021, average closing price of 4,027.23, year open 3,700.65, year high 4,297.50, year low 3,700.65, year close 4,297.50, and annual change or annual percent change is 14.41%. According to Goldman Sachs, 10-year stock market returns have averaged 9.2% over the past 140 years. Between 2010 and 2020, the S&P 500 outperformed the historical 10-year norm, with an annual return of 13.6%. However, today's stock market return could be drastically different from the 10-year average stock market return. The S&P 500's compound yearly gain from 1965 to 2020 was 10.2%, according to the company's data. While that appears to be fair overall return, each year has been different. Between January 1 and December 31, 2018, the S&P index lost more than 4%, yet values and dividends increased by 31.5% to even out. It's worth noting that these numbers is calculated in a way that may or may not affect actual investing behavior. These figures were derived from data collected at the beginning and the end of the year. Now for the second investment option, we have PSE Index. The Philippines National Stock Exchange is the Philippine Stock Exchange Incorporated. The Manila Stock Exchange and Makati Stock Exchange were merged in 1992 to become the Philippine Stock Exchange. The exchange has been in existence since 1927, including prior incarnations. A total of 275 businesses are listed in the Philippine Stock Exchange. The PSE Companies Index, or the PSEI, which includes 30 listed firms, is the primary index for PSE. A set of criteria is used to choose firms for the PSEI. 6 other sector-based indexes are also available. A 15-member board of directors led by Jose T. Pardo is responsible for the PSE index. Here we have the PSE Composite Index yearly returns for year 2009 to 2019. So for year 2009, we have the beginning price of 1,872.85, ending price of 3,052.68, gain of 1,179.83, and percent of gain of 63%. So for year 2019, we have the beginning price of 7,466.2, ending price of 7,815.26, and a gain of 349.24, and percent gain of 4.68%. The Philippine Stock Exchange Index has increased at an annual rate of 7.50% since 1988. This beats any savings account or time deposit interest paid by banks. It's also worth noting that the return on investment after 10 years is 12.21%. As a result, if you had put money into the market 10 years ago, it would have tripled by today. While this is correct, it is concerning that the 5-year and 3-year returns have not sustained double-digit increases. This could be attributable to previous years' market perceptions of inflation, as well as the government's large infrastructure program, Build, and international pressures.
Now we will proceed on the calculations.
First, we have here the S&P 500 index. The S&P 500 index was founded in 1926 as a composite index comprising only 19 stocks. Since its start in 1926 to 2018, the average yearly return has been around 10% to 11%, according to historical statistics. Since 1957, when 500 companies were added to the index, the average yearly gain has been around 8%. So here we use the interest rate of 8% per annum, investment of 100 million, tax of 30%. So we have the interest income per year of 8 million. So we less the tax of 2,400,000. So the interest income after tax is 5,600,000. So we have also the existing debt of 80 million, the interest rate of 1% per annum, and the interest expense of 800,000. So the net income is 4,800,000. So we also found the payback period. We have 100 million divided by 4,800,000 is equal to 20.83 years. So in here, the lower the better. It is the time required to recover its investment out of its undiscounted annual cash flows. So we also have here the accounting rate of return. 4,800,000 divided by 100 million is equal to 0.048 or 4.8%. Also here, the higher the better. It measures the return on investment in terms of net income. We also have the net present value. We have 19,164,960 less the 100 million. It is equal to 80,835,040. We have also the present value of ordinary annuity factor of 8% in 5 years is 3.9927. So the net present value is less than 0, so it means that the investment may or may not be recovered. So next we have the PSE index. So as shown in the table is the compounded annual growth rate of CAGR. The CAGR is like the yearly interest that investment has grown. Also, we will see the cumulative growth. It is obtained by dividing the current and past index level. So we have here the period of 1 year, 3 years, 5 years, 10 years, and since 1988. So we can see that the CAGR for 1 year is 12.11% and also its cumulative of 12.11%. And as we can see, the Philippine Stock Exchange Index is growing 7.50% per year since 1988. So this beats any interest given in savings accounts or time deposit offered by banks. So we have here the interest rate of 12.11% per annum, investment of 100 million, and the tax of 25%. So we have the interest income per year of 12,110,000. So we less the tax of 3,275,000. So we have the interest income after tax of 9,082,500, existing debt of 80 million and 1% per annum interest rate, and the interest expense is 800,000. So the net income is 8,282,500. So we also have the payback period of 12.07 years. So it indicates that the lower the better. So it is a time required to recover its investment out of its undiscounted annual cash flows. So we have the accounting rate of return of 0.08 or 8.28%. We have here the higher the better. It measures the return on investment in terms of net income. So the net present value is negative 70,143,244. So it means that the investment may or may not be recovered because it is less than 0.
As for the third option, we have gold. Gold can be purchased through exchange-traded funds, shares in gold miners, and affiliated firms, or as a physical product. These investors have as many motives as they do ways to invest in metal. Some believe that gold is a barbarous relic that has lost its monetary value. Paper cash is the preferred form of payment in today's economy. They argue that the sole advantage of gold is that it is a substance used in jewelry. Those who believe gold is a unique asset with distinct inherent properties that make it important for investors to have in their portfolios are on the opposite end of the spectrum. While gold no longer supports the US dollar or other worldwide currencies, it still matters in society today. For the world economy, it is still vital. There is no need to look outside the balance sheet of central banks and other financial institutions, including the International Monetary Fund, to corroborate this claim. These organizations currently own nearly 1/5 of the world's surface gold supply. Moreover, some central banks have joined their current holdings of gold, showing concern about the world economy in the long term. In an economic context in which investors face dwindling US dollars and increasing inflation, the belief that gold secures riches is even more significant. Gold has historically functioned as a cover for these two eventualities. Gold often appreciates with rising inflation. If investors understand that their money loses value, they begin to place investments in a hard object that has typically kept its worth. In the 1970s, gold prices rose in the midst of rising inflation. If investors understand that their money loses value, they begin to place investments in a hard object that has typically kept its worth. In 1970s, gold prices rose in the midst of rising inflation. This is because gold is valued at USD worldwide in a drop in the US currency. This association has two reasons. For a transaction in the first place, investors who seek to acquire gold, that is, central banks, must sell US dollars for this. In the end, this reduces the US dollar when world investors are trying to breed the dollar. The second reason is because the dollar's depreciation makes gold for investors holding foreign currencies cheaper. As a result, investors with currencies that have strengthened relative to the US dollar are in more demand. Gold is generally considered as an investment that diversifies. It is apparent that gold has historically functioned in the past. Whether you are concerned with inflation, decreasing US dollar, or even protecting your wealth, as an investment that can offer a diverse element to your portfolio. Gold is not linked to equities, bonds, and real property. If your focus is just diversification. Typically, gold stocks are more attractive than income investors to growing investors. Gold inventories usually increase and fall with gold. But even when gold prices fall, well-managed mining firms are profitable. Gold prices are often increased by higher prices of gold stocks. A relatively slight rise in gold prices can lead to considerable gains in the finest gold stock, and gold stockholders generally get far better ROIs than physical gold holders. Even those investors focused mostly on growth rather than steady income can benefit from the choice of gold stocks that show a dividend performance that is historically good. Actions that dividends pay tend to show more profits as the sector rises and fare better most twice as much, on average, as stocks that pay out for non-dividends when the sector generally is in a slump. Below is the gold prices historical annual data. The gold prices historical annual data shows its average closing price, year open, year high, year low, year close, and its annual percent change. In 2021, it has $1,804.43, $1,946.60, $1,954.40, $1,678, $1,771.60, and an annual percent change of negative 6.52%. In 2020, it has $1,773.73, $1,520.55, $2,058.40, $1,472.35, $1,895.10, and an annual percent change of 24.43%. In 2019, it has $1,393.34, $1,287.20, $1,542.60, $1,270.05, $1,523, and an annual percent change of 18.83%. In 2018, it has $1,268.93, $1,312.80, $1,360.25, $1,176.70, $1,281.65, and an annual percent change of negative 1.15%. In 2017, it has $1,260.39, $1,162, $1,351.20, $1,162, $1,296.50, and an annual change of 12.57%. In 2016, it has $1,251.92, $1,075.20, $1,372.60, $1,073.60, $1,155.70, and an annual percent change of 8.63%. In 2015, it has $1,158.86, $1,184.25, $1,298, $1,049.60, $1,060.20, and an annual percent change of negative 0.59%. In 2014, it has $1,266.06, $1,219.75, $1,379, $1,144.50, $1,199.25, and an annual percent change of negative 0.19%. In 2013, it has $1,409.51, $1,681.50, $1,692.50, $1,192.75, $1,201.50, and an annual percent change of negative 27.79%. On 2012, it has $1,668.86, $1,590, $1,790, $1,537.50, $1,664, and an annual percent change of 5.68%. On 2011, it has $1,573.16, $1,405.50, $1,896.50, $1,316, $1,574.50, and an annual percent change of 11.65%. And on 2010, it has $1,226.66, $1,113, $1,426, $1,052.25, $1,410.25, and an annual percent change of 27.74%.
As shown in the screen is the calculation of gold using the historical data of 10 years, considering the taxes and foreign exchange conversion. As you can see in the screen, one gold price in pesos is 87,956. In Philippine peso, it is 2,282 pesos. The actual investment of 1,137 is 100,005,972 pesos. For the purchased gold from 100M, we have a 1,137. The total asset of 1,137 gold is 2,594,634, assuming no fees paid to sell it. The interest expense is 800,000, so the net income is 1,794,634 pesos. So how do we get the payback period? All we need to do is to divide the original investment to its annual cash flow. So 100,005,972 divided by 1,228,107.26 with a payback period of 56 years. For the accounting rate of return, all we need to do is to divide the accounting net income to its net investment. So 1,228,107.26 divided by 100,005,972, an accounting rate of 1.79%.
The fourth option is Bitcoin. The first cryptocurrency, Bitcoin, was established in 2009. It's a decentralized type of digital money that does away with the need for traditional financial middlemen like banks and governments. The government that issues fiat money, such as the United States dollars, in your bank account, backs and regulates it. Bitcoin, on the other hand, is powered by a mix of peer-to-peer technology, a network of individuals similar to the volunteer editors who helped build Wikipedia, and software-driven cryptography, the science of sending secret information that can only be read by the sender and receiver. Each Bitcoin trading symbol, which is BTC, XBT, is sometimes used. It is a digital file kept in a digital wallet on a computer or smartphone. As shown in the screen, it is the Bitcoin price table yearly. The Bitcoin price table has Bitcoin price in dollars, change in dollars, and year-over-year percent. In 2019, it has 3,869.47, negative 9,542.97, and a year-over-year percent of negative 71.15. In 2018, it has 13,412.44, 12,414.75, and a year-over-year percent of 1,244.35. In 2017, it has 997.69, 563.23, and a year-over-year of 129.64. In 2016, it has 434.46, 120.54, and a year-over-year percent of 38.40. In 2015, it has 313.92, negative 456.51, and a year-over-year percent of negative 59.25. In year 2014, it has 770.44, 757.13, and a year-over-year percent of 5,690.96. In 2013, it has 13.30, 8.04, and a year-over-year percent of 152.56. In 2020, it has 5.27, 4.97, and a year-over-year percent of 1,655.90. In 2011, it has 0.30, 0.21, and a year-over-year percent of 249.65.
Bitcoin's value has surged from $3,237 in December 2018 to new highs. Bitcoin, like all cryptocurrencies, is a new concept with a lot more volatility than traditional investments like equities, bonds, and mutual funds. Many advocates of Bitcoin believe digital currency is the future. Many people supporting Bitcoin feel this helps to provide for transactions around the world with a lot speedier, low-cost payment mechanism. Bitcoin may be exchanged for conventional currencies. Indeed, its exchange rate versus the dollar draws potentially interesting investors and traders. One of the main reasons for digital currencies like Bitcoin's rise is that they can operate as an alternative to domestic fiat money and traditional products such as gold. The IRS declared in March 2014 that all virtual currencies, including Bitcoin, would be taxed instead of as currency. Bitcoin's gains or losses as capital are realized as capital gain or losses, while Bitcoin's capital gains or losses are incurred in a regular inventory. Examples of taxable transactions include the sale or acquisition of Bitcoin from other parties or the usage of Bitcoin for goods or services.
For the calculation of Bitcoin, we use the historical data of 10 years, considering the taxes and foreign exchange conversion. As you can see in the table, one Bitcoin price in pesos is 1,760,737.70. As you can see, the actual investment of 56 is 98,601,311.20. The purchased bitcoins from 100 million is 56. The total sales of 56 bitcoins is 1,927,061.36, assuming no fees paid to sell it. So the interest expense is 800,000. With a net income of 1,127,061.36. To get the payback period, all we need to do is to divide the original investment to its annual cash flow. So 98,601,311.20 divided by 1,127,061.36, a payback period of 87 years. For the accounting rate of return, all we need to do is to divide the accounting net income to its net investment. So 1,127,061.36 divided by 98,601,311.20, an accounting rate of return of 1.14%.
Next, we'll go to the fifth option, which is the Philippine Treasury Bank. Bonds are fantastic alternative for persons who don't want to be exposed to the risk of equities but want a steady and predictable income from interest. There are two forms of government debt: treasury bills and treasury bonds. Treasury bills are one-year liabilities that are frequently offered at a discount to their face value. Treasury bonds are liabilities with maturities ranging from 2 to 25 years and are typically issued at par with periodic coupon payments made up to the ultimate maturity date. Fixed income securities are generally referred to as bonds. Fixed income instruments are debt securities issued by corporations, governments, or government agencies having predetermined interest rates and maturity dates. At the time of purchase, the investor is aware of the amount of income and the timing of installments. Treasury bonds are long-term, low-risk products that represent the Philippine government's direct and unconditional liabilities. The safest investments are treasury notes and treasury bonds. Treasury notes and bonds, or PXTNS and RTVs, are short-term government securities that pay interest on a regular basis, known as interest coupon payments. Because they are direct obligation of the Republic of the Philippines, denominated in local currency, this is a reasonably risk-free investment. Presented in the table is the Philippine Treasury Bonds Historical Series, which starts from 2016 to 2021. And as we've seen, 2016 to 2018 and also 2021, it has a positive yield variation, while in 2019 to 2020, it has a negative variation yield. The Philippine government is offering 30 billion in a 3-year retail treasury bonds with a gross annual interest rate of 2.375% from February 9, 2021 to March 4, 2021. Whichever comes first, this bond issues corresponds to the formal launch of the government's bond exchange program, which will allow qualifying securities holders to exchange their present holdings for the new 3-year RTB. Bond rates are being criticized for being too low. Bonds aren't even worth thinking about as investment. There is, however, a rationale for the low yield. The reason for this is that the global economy remains in disarray. If the global economy has been solid, the developing markets' dismal performance should not be expected to continue. The bond is connecting element that links all the other asset classes. This is because the price and value of all asset types are determined by a single monetary unit. The interest rate, as a result, in order to understand the greater scheme of global investment, all investors must be conservative with bond investing. Now, let's proceed in the calculation. So, as you see in the table, the interest rate is 2.375%. The investment is 100 million. And the tax is 20% final withholding tax. So we'll compute the net income, which is the interest income per year is 2,375,000. The tax is 475,000. So the interest income after tax is 1,900,000. Then the existing debt is 80 million and the interest rate is 1%. So the interest expense is 800,000. So we'll have a net income of 1,100,000 pesos. We'll also compute the payback period, which the formula is original investment divided by annual cash flow. The original investment is 100 million divided by the cash flow, which is 110,000 in total of 90 years. So the lower the better. It is the time required to recover its investment out of its undiscounted annual cash flows. Now we'll also compute the accounting rate of return. So accounting net income divided by net investment. So 1,100,000 divided by 100 million is 1.1%. so the higher the better. It measures the return on investment in terms of net income. We'll also compute the net present value, the present value of cash inflows less present value of cash outflows. So 5,128,860 minus 100 million. So the answer is negative 94,871,140. The present value of ordinary annuity, a factor of 2.375% in 5 years, is equal to 4.6626. Next option is the pay off the debt. Investing is a method of putting money aside for the future. Ideally in a stock, bond, or mutual fund that will appreciate in value over time. Debt, on the other hand, is money you've already spent and for which a lender is charging you interest. If the debt is not paid, interest charges will be added to the amount and interest charges will be incurred. There are numerous positive advantages to choose not to invest but to pay off debt. The first is that if your loan bears a fairly high rate of interest, you could come forward. This applies in particular to debt via credit card. Another incentive to pay debt is your credit score, which is highly significant if you want to borrow money for the future like a mortgage or a vehicle loan. For that reason alone, paying off debt, especially if you have a lot of it, can be a good idea. Psychology has a role in this, as it does in investment. If your debts are keeping you up at night, you might be better off repaying them rather than investing, even if you might obtain a larger return. If you've decided to utilize your extra cash to pay off your debts, the next step is to figure out how to do it. If you have enough money to pay off all your debts, the solution is simple. Pay them off. If you don't have a lot of money, however, you'll have to prioritize. You may also have another choice if you have credit card debt. Transfer your balances to a card with a reduced interest rate and then pay them off. Some balance transfer credit cards offer promotional periods of 6 to 18 months with no interest, which might help you pay off your bill faster because you won't be paying any extra fees. Now we'll proceed the calculation and the pay off debt, which will be using WACC. The given is total capital 100 million, total debt 80 million, total equity is 20 million, and the interest expense 5 years equal to 4 million. So first we'll find the weight of debt. The formula is total debt divided by sum of total debt and total equity. So 20 million divided by 80 million plus 20 million. The answer is 0.800. The cost of debt is 1%. So we'll find the weight of equity. So total equity divided by sum of total debt and total equity. So 20 million divided by 80 million plus 20 million. The answer is 0.2000. The cost of equity is 3.75%. By using the formula of WACC, we'll have an answer of 0.011025. So the total debt is 80 million pesos with the interest rate of 1%. The total interest amount annually is 800,000, assuming we will multiply it into 5 years. So the total interest payment would be 4 million pesos.
So for the seventh or the last option for investment is the US dollar. Filipinos mostly on travel exchange their Philippine pesos for US dollars before exchanging them for the local currency. People feel that if the exchange rate is higher, they would receive more bang for the buck. They also believe that the United States dollar is a strong currency in general. US dollar is the most traded currency in the foreign exchange market as well as the world's most powerful currency. This indicates that now is a good moment to invest in the US dollar, particularly for those wishing to diversify their portfolio and maybe increase their returns. It is one of the world's most powerful currencies. Since the euro's depreciation and significant swings,
which have made its values less stable, the US dollar has taken an advantageous position. In terms of additional titans, it even surpassed the yen and yuan. In addition, the US economy has been growing in recent years. Another factor for the dollar's strength is the United States' high interest rates, which make the dollar more valuable and US bonds more appealing to overseas investors. Consider investing in US asset allocation markets, as this is the larger financial market in terms of market capitalization when considering diversifying your portfolio. They are also more liquid and provide a list of significant companies to put your hard-earned cash. As you can see in this screen is the historical data of the US gross domestic product growth rate from year 2009 to 2019. So as you can see, the growth percent is from negative 2.54 up to 2.16%. OFW money transfers reached an all-time high of $3.15 billion in 2018, increasing the yearly total to $32.21 billion, a 3% increase over the previous year. This growth benefits the country's foreign exchange yield. The money order improves the Philippines' balance of payments condition by increasing the country's foreign exchange gains. As a result, it provides as a substantial source of foreign currency for the government, boosting current account surpluses. Filipinos may now use an overseas credit card to make dollar investments, allowing them to take less risk and earn more money in a less competitive market. Yes, both OFWs and qualified native Filipino employees are permitted to invest in dollar-denominated assets. If you wish to diversify your portfolio by investing in other markets, the US economy provides both safety and high returns. It also serves as a safe refuge during times of global economic instability. When products and services are exported from the United States, customers must pay in dollars. When the US government or the American entities issues bonds to raise funds that may be acquired by overseas investors, the payment must be made in US dollars. Non-US investors must pay in dollars when they buy US firm stocks. Customers and investors must sell their currency in order to get dollars, which they may then use to purchase products, services, bonds, and stocks, among other things. This increases the value of the currency sold to obtain US dollars by boosting demand for US currency, affecting supply, and therefore increasing the value of the currency sold to acquire US dollars. Here is the foreign currency deposit unit rates of the Land Bank of the effective year of August 1, 2020. So the foreign currency deposit unit rates of the bank effective August 1, 2020 computation is the following. We have the savings deposit of 0.10%, which is from the Land Bank. The link is provided. The tax or the final tax FCDO is 15%. And as of July, 1 US dollar is equivalent to 49.31 pesos. So we have an investment of 100 million pesos. So in order to convert this into dollar, we have to compute the investment of 100 million pesos divided by the 49.31 pesos, which is the equivalent of 1 US dollar. So we have an unconverted dollar, converted amount to dollar is 2,027,986.21 dollar. For the interest income is equal to the converted to dollar multiplied to the savings deposit, which is the 10%. So the interest income is $2,027.99. For the interest after tax is equal to the interest income multiplied by the 85. So the interest after tax is $1,723.79. In interest income in pesos is equal to the interest after tax multiplied by the 49.31 pesos. So the interest income in pesos is 85,000 pesos. So we have a net loss of 715,000, which is the interest income in peso minus the 800,000 interest expense in Philippine Treasury Bond. So, in order to compute the payback period, we have formula of investment of 100 million pesos divided by the interest income in pesos. So, the payback period we have is 1,176 years. The accounting rate of return is equal to the interest income in pesos divided by the 100 million pesos investment is equal to 0.09%. So that's it. And now, let's talk about the summary of this presentation. Based on the calculations, the total net income for S&P investment is 4,800,000 pesos with a payback period of 20.83 years and as 4.8% accounting rate of return, and its net present value indicates that the investment may or may not be recovered because it is less than zero. The second investment option is the PCE index, which have a total income of 8,282,500 pesos, a payback period of 12.07 years, and the net present value of 8.28%, which indicates that the investment may or may not be returned because it is also less than zero. For the third investment option is the gold. It has a total income of 1,794,634 pesos with a payback period of 56 years and a 1.79% of accounting rate of return. The fourth investment option is the Bitcoin, which have a total income of 1,127,061.36 pesos with a payback period of 87 years and an accounting rate of return of 1.14%. The fifth investment option is the Philippine Treasury Bond, which has a total income of 1,100,000 pesos and the payback period is 90.90 years with 1.1% accounting rate of return, and its net present value indicates that the investment may or may not be recovered because it is also less than zero. The weighted average cost of capital for the sixth option, which is the payoff debt, is 1.1%, and the total interest payment after 5 years would be 4 million pesos, which comes from the borrowed monies of 1% interest rate. And lastly, when we invest our money into US dollars, there will be a loss of 715,000 pesos with a payback period of 1,176 years and a 0.09% accounting rate of return. So our recommendation in this project is that we must choose which option to provide as the greatest investment proposition. We are provided 7 options, all of which are analyzed using the accounting rate of return method, also known as return on investment or return on capital employed. It employs the normal accounting process to determine the projected gain in profit from an investment. The Philippine Stock Exchange, or the PSE index, is the most favorable of the 7 options. PSE got the greatest rate of return when utilizing the accounting rate of return with a total income of 8,282,500 pesos, a payback period of 12.7 years, and an accounting rate of return of 8.28%. Investing in PSE can yield higher returns than most other investment options. This Philippine Stock Exchange gives us the best opportunity of meeting our financial objectives and allows us to reap the rewards of our money working for us afterwards. Furthermore, it demonstrates that a well-balanced stock portfolio rises more frequently than it falls, lowering risk over time. We gain from the great value potential of the Philippine Stock Exchange over time. To further elaborate why PSE is the best investment proposal, is that the PSE is significant to the financing of productive businesses that use the cash to expand and create new jobs. As a result, it's fundamental to the Philippines' economic development. Individuals and organizations looking to invest their savings or extra assets in the acquisition of securities can find a suitable market for trading securities on it. Aside from what has already been stated, the PSE has committed to first safeguarding the interest of investors and building and maintaining an efficient, fair, orderly, and transparent market. This means that orders are filled as rapidly as possible and transactions are finished as soon as possible. The PSE has implemented or is implementing reforms to make the market more efficient. By manipulating pricing and participating in insider trading, PSE ensures that no investor has an unfair trading edge over another market participant. The assumption behind transparency is that the investor can only make educated and sensible decisions about the specific stock he wants to buy. The PSE requires listed firms to provide the exchange and the public with timely, comprehensive, and accurate material information regularly. So that's all for our presentation. I hope that you've learned something from our investment proposal presentation, specifically on deciding on which investment option to choose and is considered as the best option that would give you a favorable return in the future when you will invest your money. Thank you!